if you're in this for the trading side, there's still more selling that needs to happen. If you believe the numbers and you believe that about 10,000 people own about 33% of Bitcoin, you throw out Satoshi's number, you're still dealing with, 30%, 28% of $2 trillion. So if there was a true distribution, which I think there will be, I don't understand how it's hard for people to imagine that if you put $1 million into Bitcoin 11 years ago, you've gotten 1,000 times.
Jordi Visser starts by going straight to the heart of the issue. If Bitcoin still feels heavy at these levels, he argues, it is because a small group of enormous early winners is still offloading into the market. Imagine sitting on 1,000 times gain and trying to rebalance a portfolio that has become dangerously concentrated. That kind of profit does not quietly disappear. It has to be sold into someone else's demand. In Visser's view, until that wave of selling has flowed through, Bitcoin's price action will feel frustrating and choppy, even if the long-term story still points higher.
Well, I think the concept of the IPO distribution, which I feel very strongly about, just in terms of thinking about what's been going on this year and just going back and putting it in the context of assets. And I think that's the one thing, whenever I speak with the community and I hear the frustration, there's always some correlation or some part of the asset market that fits into Bitcoin. And this goes with any IPO in general, meaning you can't separate the market from the asset. And in the case of Bitcoin, let's leave it alone as not crypto. Let's treat it as a financial asset. So the bond market's been garbage, which we know about.
Here he frames Bitcoin's current phase as its own kind of IPO moment. In a classic initial public offering, early insiders finally gain a liquid public market where they can unload stock into new hands. That process almost always creates volatility as supply rushes to meet fresh demand. Visser is telling frustrated holders that Bitcoin is not operating in a vacuum. It is moving inside a larger financial landscape where bonds have struggled and risk sentiment is still healing. When you stop treating it as some separate crypto thing and instead see it as an asset in a messy market cycle, the slower grind higher makes more sense.
But I think if you break down the parts that are relative for Bitcoin and you go back and you go, okay, except for Bitcoin, what's actually worked over the course of the last 4 years inside the crypto space? The altcoins they're still not up to the highs as an index as they were back in 2021, 2022. And if you look at similar markets to the altcoins, you get into the VC world, you get into the private equity world, you get into the private credit world, you get into the commercial real estate world. All of those have been under some form of distribution and markdown for a while. So in theory, altcoins have actually done better. Bitcoin's obviously gone up during that period.
Visser broadens the lens even further. While Bitcoin has punched to new highs, much of the broader risk universe is still digesting the hangover from the last bubble. Altcoins, venture capital deals, private equity, private credit, even commercial real estate have been living through their own markdown cycle. That means a lot of portfolios are under pressure and rebalancing. Against that backdrop, Bitcoin is actually the strong one, yet it has to absorb selling from sectors and investors that are still cleaning up old positions. In other words, you cannot expect parabolic upside when the rest of the high-risk world is still in repair mode.
I really think people should go back and look at what happened after the NASDAQ bubble in early 2000 and how long it took. It took a decade to get back to the prior highs. And Bitcoin already took out the highs. So I'm separating it as it's a financial asset that needs to be part of people's portfolios.
When people complain that Bitcoin has stalled around a psychological level, Visser points to history. After the dot-com bust, it took the Nasdaq about 10 years to reclaim its former peak. By contrast, Bitcoin already made new highs after its own brutal 2022 drawdown. From his perspective, that puts the current consolidation in a very different light. Instead of a failure, this range looks like a normal breather for an asset that has already done something the old tech index needed a decade to achieve.
But the parts that it doesn't need to be part of people's portfolios, meaning the altcoins, the things that don't have institutional adoption, I still think this is related to a dramatic overhang on the illiquid markets that are having an impact on this space. And over the course of, unfortunately, the last 2 weeks, for people that wanted to see some kind of a bid, now you've had a dramatic fall in a lot of these non-profitable speculative stocks.
He draws a clear line between Bitcoin and the rest of the crypto zoo. Coins without institutional adoption, meme projects, and speculative tech names are still unwinding excess. That dramatic overhang spills into the perception of the whole space, making allocators more cautious even about higher quality assets. Recent sharp drops in unprofitable growth stocks are another sign that the market is still punishing anything perceived as too speculative. For Bitcoin, that means it has to carry the burden of being the flagship asset in a neighborhood that is still under construction.
So again, I think people have underestimated how much money is in the illiquid markets from the VC world. And I mentioned this in the paper. You obviously had a bubble in crypto that peaked in the late 21, early 22 period, but you also had massive SaaS investments. So then rates go higher, that obviously hurts. But then AI happens, and artificial intelligence is an incredibly disruptive force, not just to public companies that aren't adopting to it, but in particular, a lot of those SaaS investments, like look what's happened to Salesforce.com and Adobe, public SaaS companies. AI has made SaaS a questionable investment place. And
Visser then digs into a problem many Bitcoin fans never think about: the illiquid corners of the market, especially venture portfolios and SaaS-heavy growth bets, are stuffed with investments that no longer look as attractive in a world of higher rates, and exploding AI crypto's own bubble peaked around late 2021 and early 2022, right as those other areas were also overloaded. As AI became the new story, older software bets started to look stale. That has left a lot of funds sitting on paper losses and questionable marks, which increases the pressure to raise cash wherever they still can.
And so when you have VCs that have a lot of investments tied into this, at the same time, you've seen the stories from the endowments needing capital and trading things at down levels. You've seen the problems that have shown up in first brands recently in private credit. You've seen the private equity public companies that have gone down. I think this overhang of illiquidity in there is driving people more towards the liquid markets. I think that's one of the reasons why the public markets have done so well in spite of that, because there are earnings that are growing, but that illiquid market doesn't get counted as much.
When venture funds, endowments, and private credit vehicles all need cash at the same time, the easiest lever to pull is liquid assets. Bitcoin, for all the talk of long-term conviction, is one of the few crypto-related holdings that can actually be sold in size on any given day. Visser argues that this liquidity premium cuts both ways. It makes Bitcoin attractive as a store of value, but it also makes it the thing institutions hit when they need to raise money quickly. That helps explain why public markets and big cap assets can perform reasonably well, while still feeling pinned down by invisible selling pressure.
It's one of the reasons why, if I look a year out and everyone that's focused on the Clarity Act, tokenization is needed, and it's needed to bring real-time pricing. So one of the reasons that pension funds, endowments, insurance companies had invested in the illiquid markets was because there was no mark to market. So no mark to market is a good thing when markets are going higher and these things are just kind of getting new valuations. But when they're not getting up rounds, it's a problem.
Looking ahead, he sees tokenization and better transparency as a key part of the solution. Illiquid assets were attractive to big institutions, partly because they did not have to be marked to market every day. That looked smart in a rising environment where every new funding round seemed to justify a higher valuation. In a world where up rounds dry up, that same opacity becomes a headache. Real-time pricing through tokenization and blockchain rails could, in Visser's view, help clear the fog. Once these hidden losses are fully recognized, the forced selling that weighs on Bitcoin today could finally ease.
And I think the altcoins and all the investments inside the crypto space are going through what happened after the dot-com bubble. And let me get rid of the public markets. The VC market was hurt a lot too. And what happened was Google is probably the most famous and biggest of the IPOs that happened in 2004. And if you go back and look at Google coming to the market, that was a big deal because they needed cash. They needed to deliver some liquidity out into the LPs. And I think that's a big part of what's going on.
Put together, Visser paints a picture of Bitcoin stuck in a transition. It has already proven itself enough to trade like a core financial asset. Yet it is still tied to a broader ecosystem of speculative bets that are working through a post-bubble hangover. Early whales are de-risking, venture funds and endowments are searching for liquidity, and illiquid markets are slowly waking up to the need for honest pricing. In past cycles, the same kind of overhang eventually gave way to fresh leadership once the selling was done, and new giants like Google emerged from the rubble. After hearing Jordi Visser's explanation of distribution, illiquidity, and tokenization, do you think Bitcoin is simply biding its time before the next major leg higher? Or do you believe this structural overhang will keep it stuck below its potential longer than the bulls expect?